So the impact has been pretty harsh. And just like in the developed world where you've had the markets kind of run up mostly on cheap money, in India, the markets have not moved on economic or earnings fundamentals per se. They've really moved on the availability of risk money from overseas, which wants to allocate to Indian stocks. That has driven markets. And local investors who seeing the bank deposit interest rates coming down, who've been encouraged, rightfully so, to move their money into equity mutual funds. So these have been the two big sort of drivers, flows of money, domestic, and flows of money from international investors, not earnings. So pre-demonetization, November 2016, the markets were at the 30,000-ish kind of levels. Then you had demonetization, and that was not a good thing for the economy at all. And then on July 2017, you had the introduction of GST, which was another, in our view, very bad policy that was announced for the Indian economy. And the reason it was bad, to take a few seconds on that, was that we believe that GST has a unified sales tax, when really what they should have done was remove octroi. Octroi is a tax you pay when the goods crosses borders, and that had slowed down, the time that it takes for goods to move from Maharashtra to Karnataka, or Maharashtra to Goa, Maharashtra to MP. And there's always friction. When you have longer time, you have friction. The friction is someone at the gate at each border who demands his share of the cut to let the goods go through. So that had gone on. That was fantastic. But then to have a nationalized unified tax was not, but that's another discussion. So GST was not a bummer, if you will, for the economy. So we're kind of back to those index levels. And I think it's interesting to note that between the time of Prime Minister Modi's first election win in May 2014 and now, so pretty much over the last 6 years nearly, the index has risen very sharply, the BSE 30 index. But 66% of the rise of the index has really come from 3 stocks. 66% of the rise of the BSE 30 index has come from 3 out of 30 stocks in the BSE 30 index. So 10% of the stocks have accounted for 2/3 of the rise of the index. HDFC Bank, Reliance, and HDFC. These 3 stocks have accounted for the major move of the index. So it tells you that there's something wrong with the overall economy. It's too narrow. A bit like in the Western world, you've had what they call the FANG stocks, which have moved, the tech-driven stocks that have driven the NASDAQ, that have driven the market, that have powered the gains, much of the gains in the Western world. So the Netflix, the Googles, the Alphabet, etc., Apple, etc. So the markets have now come down to those sort of levels, demonetization, GST, that level. And that was about 5 years ago, 4.5 years ago, 4 years ago. So between then and now, the earnings of companies have grown by about maybe 15% over that 3-4 year time horizon. So I'm buying the market today at the same price as it was 3.5-4 years ago, and the market's giving me 15% more in earnings. So I'm actually getting it 15% cheaper than what it was 3-4 years ago. Of course, you don't buy shares for the earnings they gave you in the past. You buy shares for the earnings they give you in the future. So to that extent, you have to now say, okay, the market's inexpensive. It's down to very good levels. But what does that tell me about the future earnings of the economy? And that's still a very big unknown. The government is still not got its act together on coming up with a solid, sensible, believable, achievable game plan on the Indian economy. They tinker with this, they tinker with that, they announce a budget and they modify things, but there's no big concerted effort to say, hey, this is what we need to do. And the markets have been waiting for that. And it hasn't yet been sort of delivered, if you will. So until we're sure about when that recovery of GDP happens, we cannot be sure about when the recovery of corporate earnings will happen. And therefore, how do I decide whether I should buy the market at a 30,000 level or wherever it is, or should I wait? So our argument has been, well, over the next 2-3 years, you hope that this government figures out what's to be done. And if they don't, find the market kind of self-corrects, or the economy self-corrects and goes into what we call a cyclical recovery, where it just, the cycle on its own, kind of, you do not take medicines from a doctor when you're ill, you let the body kind of figure out how to heal itself, and you get to some level of healthiness. May not be the best as if you went to a doctor, but you get to some level of healthiness. So if the government can't give us that prescription, that boost shot to get the economy going, we cyclically recover, right? So we kind of, it's not the best recovery, but it's okay, we'll go for some time. So given that there'll be some cyclical recovery over the next couple of years, it would make sense to allocate money to the stock markets. We've often said that there's an asset allocation table you should follow, and we've said that at these levels, the markets we thought were a little expensive. So yes, have equity, but keep some money aside. And I know that's what I'm doing for my portfolio, my personal portfolio. I've started moving money away from the safer quantum liquid fund into the riskier quantum equity mutual funds, because I see the market levels to be attractive. And on a 2-3 year view, that to me is like a reasonable expectation that the market prices of shares will recover again.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.